Hey guys, thanks for tuning on in. Before we get started, I just want to take a little minute and talk about our free Facebook group called Credit Score Hackers, where you can get answers to your credit questions from experts in the field as well as people in a similar situation. So, thank you guys so much once again for tuning on in, and I hope to see you on the inside. Hey, and welcome back to the Credit Agent Show. On today's episode, we're going to be talking specifically about how mortgage rates are changing in today's climate. Now, mortgage rates are always going to be changing, but some interesting things are definitely kind of happening, specifically within that real estate sphere that we believe is worth mentioning today. So let's go ahead and dive on into it. So to give a little bit of a pretense on some of the changes that I'm going to be discussing, let's talk about what happened during the pandemic of 2020. Essentially, what happened here is the Fed cut down interest rates to basically zero. Now, essentially what that means is it made it a lot easier for banks to lend out money. So we did see mortgage companies during this time essentially give out rates on their mortgages to as low as 2%, maybe even 1.9% for 10 to 15 year fixed mortgages. It was probably one, if not the only time, where these mortgage rates are going to be as low as they are. Once again, kind of because these were very uncertain times, and the Fed especially was very unsure about the economy during this time. So those days, though, are probably over now that we're in 2022 and we're seeing kind of the pandemic and the dust from the said pandemic settle down a little bit. So flipping the script back to today's changes, as of the third week in March of 2022, the national average interest rate rose to 4.54%. Now, that is going to be for a 30-year fixed mortgage as well. I think that the days for those 2 to 3% rates for 30-year mortgages are probably over, kind of like what I stated. Once again, kind of that pandemic dust is settling, and a lot of the banks and the Fed are also feeling a lot more comfortable with the economy right now. Interestingly enough, the FHA 30-year fixed mortgaging is kind of averaged at 4.46% right now, which surprisingly is going to be lower than a lot of the more conventional financing routes. These average rates are based on the top 200 lenders with a loan-to-value ratio of 80% and an applicant with a FICO score of around 700 to 760. So generally a very good to excellent credit score. So now to discuss a little bit more about some of the logistical sides of how this functions. Well, 80% of a loan-to-value ratio, or LTV, means the mortgage lender only financed essentially 80% of what the total home is worth for. This also means that the consumer or borrower put down 20% total. Once again, this data is based on people who have a 700 to 760 FICO credit score, but they also saw an average rate of 4.54% when it came to a lot of their mortgage rates over the next to zero during the 2020 pandemic. Now, some people don't put down 20% total for a home, as well as don't have a 700 plus credit score. So let's discuss some of the other kind of averages that we've also found from this trend of data. Well, some not only put 3.5% down, but also have a FICO credit score between the ranges of 640 and 680. That means if you do the minimum 3.5% down, but you also have a mid 600 FICO credit score, then you could see a slightly higher interest rate overall. There are going to be some states with a slightly higher interest rate, however. States like New York, New Hampshire, Connecticut, and Massachusetts saw an average of 4.59%. So maybe that's just because a lot of people are moving there. So moving on to a discussion about macroeconomic factors, they've honestly been keeping the mortgage market pretty low, which is a good benefit. The Federal Reserve as well has been buying billions of dollars in bonds. Now, on January 26th, however, the Fed announced that it's going to slow down their bond purchasing to help combat the rising inflation. The Fed's Rate and Policy Committee, which is known as the Federal Open Market Committee, also known as FOMC, meets every 6 to 8 weeks per year, and that is actually going to be happening this year as well. So they meet 5 to 7 times more this year, however, which means we could see 5 to 7 more rate increases, but hopefully things don't get too out of control or crazy here. So you may be thinking, is it a good time to buy? Well, because of inflation and or if your landlord is raising your rates up to 50%, but you have below a kind of 700 credit score or you're not willing to put 20% down, it may be a good time to contact us. Things as they kind of seem right now are only going to get a little bit worse. So start your credit repair journey today, get yourself into those 700 credit scores, and really start getting those mortgage rates you personally deserve. So my name is Michael. Be sure to check out our website for all of the information about our program, as well as a free 15-minute consultation. We'll also throw down some links to our newsletter that gets released every single week for you, as well as our podcast where we discuss in more depth a lot of the topics we discuss here on our YouTube channel. So we'll have all those links down in the description below. Don't forget to hit that subscribe button and be sure to give us a like as well and comment any kind of, questions you have regarding credit and you'll get featured in a future video. So once again, thank you guys so much for tuning on in and we hope to see you in the next one.